In the fallout of the insanity in 2021, with all the meme stocks and a variety of other ridiculous trends, we've seen the prevailing narrative emerge that the stock market is rigged against the average investor. The belief that the markets are being manipulated by BlackRock, Vanguard, and other large financial institutions. But is that actually true? Well, both yes and no. So let's get into it. In some ways, it has been rigged against retail. There's been controversy around brokerages like Robinhood selling order flow data to hedge funds, allowing for the front running of trades, which are primarily coming from retail investors. Recently, we've seen a former JP Morgan gold trading executive sentenced to 2 years in prison for 11 charges of manipulation. So we know that it's certainly possible that there's manipulation going on at times, but the odds can also be stacked against you in other ways. When you invest in larger market cap companies, it's far less likely that there will be glaringly obvious discounts in this area of the public markets. There are less opportunities to buy undervalued stocks when we have so many investors focusing on and valuing particular companies. And this is a point that Charlie Munger has discussed previously. Watch.
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. And it's a radically different world from the world we started in. And I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
But they're trying to outsmart each other in arenas that you don't have to play. I mean, if you look at that government bond market, the Treasury bill market, I mean, you've got this one bill that's out of line with the others. We bought over $3 billion of it the other day, but those are people. The world is overwhelmingly short-term focused, and if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year, and the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years. And I just think that I would love to be born today and go out with not too much money and hopefully turn it into a lot of money.
So Munger thinks that opportunities are dwindling just because there's so much competition. But Buffett pushes back on this a bit and correctly points out that everyone is trying to battle in the same arena. Ideally, we want to avoid competing with the smartest people in the room, aka the institutional investors. Now, how do we do that? We avoid the stocks that they can actually buy in the first place. This fierce competition that we see at larger scales in public markets is entirely avoidable. The size of these institutions limits the number of stocks that these institutions can buy, because they have to make deals in the billions for it to make much of a difference for their overall returns. Even if Berkshire were to buy microcap stocks, or penny stocks as they're often referred to, that could 10x in a matter of years, it wouldn't matter for Berkshire, because the company is worth $750 billion as of the recording of this video. Microcap won't move the needle, and it doesn't even do much for firms significantly smaller than Berkshire, so it doesn't make any sense for them to waste their time on smaller opportunities. So the point is, the stock market is not rigged against you. You're probably just playing the wrong game. And most people do, as large caps are viewed as the safe investments. And you're not going to find any financial advisors advocating the average person buys penny stocks. The large cap sphere is an area of the public markets with the liquidity and size for anyone to participate. This means that you will, in fact, be at the mercy of institutional investors, who, according to Pensions and Investments in 2017, made up 80% of the market value in the S&P 500. Institutions control the larger stock market ecosystem, and oftentimes in normal markets, great deals will rarely emerge in sectors so followed. The answer is to invest in micro or nano cap companies, which are around 300 million or less in market capitalization. This area of public markets often gets a bad rap, and it hardly makes sense when people think so highly of venture capital or private equity. This is a similar concept, but it's just available for the average investor in public markets. But that's also the problem. If you haven't learned how to properly research the fundamentals of public companies, then it's pretty easy to fall for a scam, or just invest in a company with poor growth prospects. The benefit of investing in large companies is that in most cases, their growth and products have already been proven. You can go back into their public filings and look at their history. And most of the time in microcaps, it's the exact opposite. These companies are unproven or they're unprofitable. But if you put in the effort to find the diamonds in the rough, the results can be extraordinary. As I pointed out in my previous video about 100 baggers, a book about 365 stocks that have 100x since the 1960s, most of them were microcaps at the start of their journey to success. It's not easy to achieve those types of returns, but it's only possible in the smaller deciles of the stock market. Amazon's not going to go up 100x from this point, but it already did that when it was a far smaller company. So as mentioned earlier in the video, after Warren Buffett was talking about their issue finding deals at Berkshire, institutions cannot buy microcap companies because they're just too small to make any real difference to these institutional investors. BlackRock, Vanguard, State Street, these companies can't touch you here because they can't even buy in if they wanted to. The microcaps are genuinely inaccessible, and there are often rules in place set by these firms or regulations against these companies to stop them from buying stocks that are trading below a certain stock price point, or especially from buying companies trading in over-the-counter markets, which is where most microcap companies tend to trade. For any decently sized institutional fund to start looking at a microcap company, they need to at least be at a market cap of around 100 to 200 million. But even then, they likely need to be uplisted to a better exchange like the Nasdaq or the Toronto Stock Exchange before institutions can really get access. So, even if they can, the stocks are too illiquid anyway for institutions to buy a decent position without massively moving the stock. So ultimately, all these factors just mean that large investing firms will not be involved in these stocks until they get to far larger market caps. This inability for institutions to buy these companies means that anyone who can buy in is a retail investor. There are no teams of full-time analysts looking at these stocks, and there's a good chance that there's no analyst research report out about any particular company you might be looking at. With so few eyes looking at these companies, it's far more likely that you could potentially see some incredible opportunities. Competition is so low because everyone in the financial industry tends to avoid smaller companies. The common belief that all penny stocks are trash, this idea contributes to the potential returns that you might get if you have a higher risk tolerance and start investing in this sector of the public markets. So illiquid, and very important, illiquid micro and nano-cap stocks are the best performing sector overall. This graph even factors in the stocks that went to zero. All this outperformance is because of institutions needing to wait to actually buy these companies. If you have a stock that goes from a 50 million market cap to a 200 million market cap, mostly from other retail investors buying in, and then at that point institutions can start buying as well, then that naturally provides a tailwind to the investors that bought in early. Now that institutions can finally get a piece, they have to buy shares from people like you. You become the one in control. You have the advantage from all the previous reasons I've laid out. As funny as that sounds, if the institutions want to own a stake in a company, they have to buy it from you. Does all this mean that it's impossible for microcap company stock prices to be manipulated? No, it can still happen. There are still short sellers, but they're probably retail investors like ourselves or smaller institutions. Does all this mean that it's easy to find stocks that will outperform the broader stock market if you buy microcaps? Definitely not. It's going to take a lot of work and research to find companies that have promising and sustainable prospects, especially when information can be less readily available. Because like I mentioned earlier, for any microcap you look at, there's a good probability that there are no existing research reports or analysts looking at the company. You will need to embrace volatility, because there's going to be plenty of that in illiquid microcaps. It's likely that you'll have to have a higher risk tolerance. You'll need to watch whatever interviews are available online that have been done with management, or schedule your own with them as well, which is possible in the smaller stock market ecosystem. You'll need to read press releases and company filings to understand what's going on with the stock. You'll need to make sure you fully understand what a particular company does and what might affect its stock price. So there's definitely some work involved here. But if you want higher returns that will beat the indexes, and to avoid a lot of the BS that you see with larger companies, this is the trade-off that you need to make. Although there's BS going on with companies at any size. So you're going to have to roll with the punches and continue to learn over time. And if this sounds like it's too much work, or you don't have the time, or you don't believe me and you think all microcaps are junk, then that's perfectly fine. There's no shame in avoiding stock picking entirely and just continuously investing in index funds or a few ETFs. In fact, this is what Warren Buffett advises most people do, because the average investor fails to come even close to the returns of the S&P or the Nasdaq. If investing doesn't interest you, instead of spending all this time trying to research companies, you can instead go develop other skills or start building businesses if you have an entrepreneurial mindset. There are other productive things that you could be doing if you're not determined to put the work in that is required to succeed in stock picking. But I'll make this clear. If you want to outperform the indexes, which most people can't do, then you're going to have to do things that most people won't. You're going to have to invest in places most people avoid. Otherwise, going off of how the typical investor performs, indexing is going to be the best option for most people. So that's something to consider. But thanks for watching.